Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Once again, happy Friday, everybody. Hope you guys are doing fantastic. Well, the rates finished the week actually worse than where they ended last week. We are going to just see a whole lot of volatility here. We saw a lot of volatility this week, not only due to the economic data, but also because Janet Yellen was testifying before Congress, and she gave some pretty good insight as to what the Federal Reserve is thinking, what their plans are. First, with the economic data, things are just continuing to show that the economy is actually doing quite well. We did see the producer price index coming in, not increasing over the previous month, but still maintaining a pretty good level, showing the year-over-year number being at 1.6%. The consumer price index, though, that showed a big jump. It was at 2.1%. Now the consumer price index is at 2.5%. Remember that the Federal Reserve's target rate of inflation is 2%. Now, CPI isn't their favorite gauge of that, but it's definitely showing here that we're pretty much reaching the Federal Reserve's kind of target for inflation going forward. Philadelphia Fed index was the best index since the 80s. So that showed a big increase. The Dow Jones Industrial Average also this week set multiple all-time highs throughout the week. So stocks are doing great. The economy looks like it's doing well. And the job market is showing signs of maybe being close to potentially full employment, even though it may not be the best paying jobs out there. But, you know, the jobs numbers are good as far as the Federal Reserve, what they would want to see. And we're seeing some inflation in the market. Now, the Federal Reserve chairperson, Janet Yellen, testified before Congress for 2 days. And the first day, which was Wednesday, did send some shock waves into the market, and interest rates actually had a pretty bad day on Wednesday. They recovered since a little bit. But basically, here's what she said, is that the Federal Reserve does see signs. Now, they've said that they're probably going to be hiking another 3 times here this year. And she said that they want to get ahead of this because they don't want to have a shock to the economy, that finding out if inflation's going up way too much, that they're going to have to raise higher and quicker, sending a shock to the market. So that really put the potential for a Federal Reserve hike here on the table for March. Who knows if it'll happen, but it is definitely on the table, and the market's reacted to that. The other thing just to think about is that the Federal Reserve does like to hike interest rates only when there's a press conference afterwards. There's only 4 more meetings this year with press conferences afterwards. March is one of them. So if they're going to hike 3 times this year, if we were to take her at her word, then March would be a pretty good time to do it. Who knows, again, if that's going to happen, but there's just going to be a lot of talk about continued Federal Reserve hikes. The other thing that really is should be even more on the radar screen in terms of the effect of interest rates is when the Federal Reserve will stop reinvesting some of the payoff of all the mortgage-backed securities that they bought. They're reinvesting that money. It's to the tune of about $9 billion every day. And so if they start tailing back on that, then that's going to also provide some additional pressure for interest rates to go higher. So it's going to be just very volatile. Clients should be in a locking bias. We're advising that. Rates are still phenomenally low. And so you just might as well lock them because the trend is towards the upward side. And also remember, if your customers are talking about and complaining about interest rates being high, give me a call. I can help talk you through it. And just kind of reminding them of how low they really are and strategies that they could use in the future. I mean, rates will probably continue to rise here over the next 12 months or 18 months, but these things go in cycles, and eventually we're going to, hit a bump in the road and end up with a recession. That's why the Federal Reserve wants to put more of these bullets back in the gun so they can make more accommodative stances when they need to do that, and then they'll have a refinance opportunity later on down the road. Just as if anyone's owned a home for the last 10 years, they know they've refinanced multiple times. So just because you have a great rate at 4.5%. It's not there yet, but let's just say that was the number. That doesn't mean that you can't refinance if rates go lower. So, and 4.5% from a historical basis is phenomenal. Yeah, it may not be 3 3/4, which we saw last year, but it's still really, really great. So if you have any questions, please give me a call. Thanks for joining me with Java with Jared. If you have any questions, always call, and we'll talk to you soon. Bye-bye.